question one. Well, I'll start at the bottom and go up. Question one, regarding the MSU, does the pullback candle with the engulfing candle have to pull back all the way into the imbalance of the ISC, or does it just have to pull back?
No, so they are mutually exclusive. I think that's the right use of the phrase. They are mutually exclusive. So they both have their own rules. They are both necessary. And the only thing that the MSU needs to do, let's try and find one. The only thing that the MSU actually needs to do is pull back and sweep some form of liquidity. So just try and find a good, really clear example. None of these are actually that good. Okay, let's use this one here. So there are better examples, obviously, from time to time, but this one kind of gives us what we need. Okay, so we would all agree that that is an ISC, right? 3 candles above liquidity level. Okay, it's internal liquidity level, admittedly. Okay, but it has actually no, it's taken external as well, so we can take that one there. So that's actually a really nice example of an ISC. Okay, so the ISC needs a sweep, obviously. It can have no more than 3 candles above the liquidity. Now look, if you've got a 4th wick in the ISC and it's a really clear ISC with imbalance left behind, I'm not going to say you have to ignore it, okay? We, in an ideal scenario, want no more than 3 candles. The reason why that rule is there, and the reason why I put that rule there, is so that we can have a really clear liquidity move, okay? For example, if you have loads of candles above, so if you have, no good examples here. Okay, if you have loads of candles above like that, then you can clearly see that that's a messy, that price has moved up, pulled back, moved up, pulled back, moved up, pulled back, moved up, pulled back. Okay, that's not an ISC. Yes, it's a liquidity sweep, but it's not an ISC. An ISC has to show clear rejection. If you had a 4th,
just go check. Go back. Would you just zoom out a little bit?
Every weekend, I host a Sunday webinar with my mentorship students. Starting from March 2024, I'll be opening this up to my YouTube family too. Get an insight into the way that we trade, the strong money Forex strategy, and a taste of the profits. The best part is, it's completely free. All you have to do is head over to my Instagram @strongmoneyforex and send me a DM with the word webinar.
There you go. Just look at that range and look at the ISC just where your new session starts. That's a real ISC.
This one here.
Yeah, it's just of a larger range.
Yeah, do you know what? Good example, yeah. So on a higher time frame, on a 5-minute time frame, that'll be a really clear ISC. Okay, because and then you've got, so this is actually, yeah, well done. Good example. 1, 2, 3, 4.
That's literally my strategy.
Yeah, there's 4 candles above there, but we can clearly see that that has had clear rejection. So the 3 candle rule doesn't have to be followed exactly, okay? If you've got a 4th wick there, then, you know, it's not the end of the world. It's important to understand that it is a price movement. And if you wanted to trade it absolutely mechanically, you can, but there will be times where you miss out on trades, okay? There's another one there. It's only taking internal liquidity, as you can see, but there's another one there. You know, that I would still class as an ISC. The important thing is that we show clear rejection of liquidity level and we leave behind some form of imbalance. If you have those bits and bobs there, then you have everything you need to take a trade, okay? So the ISC on its own, we want a clear liquidity sweep. We want enough momentum in that move that it leaves behind imbalances like this move did here. Okay, pretty self-explanatory. We've got our New York trap there, so we can mark that on. So we've got now another confluence to indicate that our trade is going to go in our direction. And we've got this clear impulsive move, sweep of the trap. Okay, that's a really clear ISC. Now, the MSU has its own rules on its own. All we need from the MSU is we need a push down pullback, another push down, and then we need a liquidity move and an engulfing. Okay, so technically the first MSU has been validated here. Okay, so that technically is the first MSU. And the reason why I don't draw my MSUs tight like some people do and put my stop here is because we have that risk that price could pull back up. In an ideal scenario, the MSU will pull back into premium, okay? And by premium, I mean the top half of the ISC leg, okay? So anywhere above that equilibrium line, which I think was there, would be valid in my opinion, okay? But if I was taking that and I was really worried about the trade moving off, I would have to have my stop above the ISC. And that's why I have that rule in there, that the stop has to be above the ISC. Now, what I prefer to happen is I prefer that the MSU sweeps liquidity and creates our engulfing in the top half of a range. So if I just mark on the range again, I prefer, okay, that this happens in that top half of the range. And if it happens in the top half of the range, then we have obviously a much better risk to reward, right? Because then we can take that trade with a stop above the ISC. Okay, you take off first target or whatever you set. For me, I'm getting 2R out because the first liquidity point hasn't given me that. I'm going to go to the next liquidity point that gives me that, which is down here. So that's my 2.3 trade. Okay, I'd be rather taking trade like that than that for the obvious reasons. So you may want to, if you're trading ISC MSUs, because with this one you've got to wait all the way down to like here. You've got to wait for key liquidity to be taken.
Check just whilst you're on that little range there. That's a perfect time to segue into the next question that this guy has. Does the imbalance the ISC leaves behind need to be filled before the MSU candle, before the MSU engulfing candle continues in our direction? So does the imbalance of the ISC need to be filled?
No. So the imbalance shows momentum and momentum only, okay? If it tags the imbalance, which it often will do, that's fantastic. But they're mutually exclusive, okay? They don't have to. This doesn't have to come into the imbalance. It often will, but it doesn't have to. All I want to see is I want to see the MSU setup, which is the structure, okay? Often you'll get them, you know, what we class as a hidden MSU. So if I jump up to this time frame, let's get rid of some of this mess so you can see. So when we talk about hidden MSU, let's say this was the 1 minute chart. We have to understand that candles have formation within them, okay? So that is structure. These wicks are structure, okay? So that technically is an MSU on the 5 minute time frame. It's what we class as a hidden MSU because that's the structure on the way down, okay? Why is it hidden in MSU? Well, because it has no white candles on my color scheme. It has no white candles signaling that we've got the bearish structure there. But that would be, let's say that was your 1 minute time frame, that would still be a valid setup, okay? If we draw on our range again, we've come into premium pricing by tagging into there as well. And we've got an engulfing. So that in itself on the 5 minute time frame in this example will be a perfectly reasonable trade. I'd be nervous about that simply because we've got to clear a major liquidity point, okay, or in this structure anyway, a major liquidity point before we can get our 2R out. And what could happen is price could reverse. That make me a little bit nervous, but it's still a valid trade. So no, it doesn't have to go into the imbalance, but it probably will.
Okay. And question 3 from the same guy. Do we need to consider the depth of the pullback using the premium discount fib tool in either of the ISC or MSU or New York Open setups? And I think you kind of answered that just there with yes, you want to see it pull back.
So we always, so this is where we've got two different types of premium discount, okay? When we're looking at a higher time frame range, okay? When we're looking at a higher time frame range like this big move here, okay? Ideally, we wouldn't be selling, although we can, ideally we wouldn't be selling from this box here, okay? Because although this is premium, it's not premium how we like it, okay? What we like from premium is that top 25%, and that is our true premium pricing, okay? The top 25, okay? We are valid from sells, and what we've normally done is we've normally created EPA, okay? So if we use that EPA level there, okay, we've normally created EPA, okay? And what you'll often find is in these pushes, in these moves, EPA is normally somewhere in this region, okay? If it's lower than the equilibrium level, then that makes me a bit nervous. We ideally want EPA in the equilibrium or above, okay? We don't absolutely have to have premium pricing to take a sell trade, and we don't absolutely have to have discount pricing to take a buy trade, because if we're trading in line with the momentum, as you can see in this example, it has reversed and started to push down quite impulsively. So this is where then I'd be using my other confluences, like we've got the New York Open here and the New York Open trap, to get into this trade. And you'll see that obviously this pullback here in this range leg that we're in, this pullback here has once again come back into technically premium pricing, and by that I mean the top 25. Okay, we're not in that top 25, we're in the top 50, but that is valid to take sells from. When you're looking at ISC MSUs, the same thing really applies, okay? As long as we're in that top 50%, then we can take a trade. Ideally, we'd like it in the premium, okay? But there's a couple of theories, isn't there? You get really high value in the premium section, which is great, but also if price is really momentous and it's having a really heavy push down, then it may not actually need to get all the way up there. It may not be able to get all the way down there because the bearish pressure is so massive. So I think this is where you've got to use a little bit of subjectivity. And if all the other factors and confluences that you need are there, I wouldn't say don't take a trade because we haven't come into the top 25%, okay? But that's where I use that is where I'm looking at, much bigger ranges to trade off the back of. Let's just try and find you an example. So if I was on like the 50-minute time frame here, okay, and I was using, let's have a look. So this range here, okay, we know that we've come into really high value, okay, although there was a new range printed down here, okay, the premium pricing here has still got value in, right? Okay, you all understand that? Same thing for this bullish one here. Excuse me, okay, Steve. Excuse me. Same for this bullish range here, okay? Our discount pricing, I'd be looking at trades from here. Can I look for trades from this top 25%? Sorry, this middle 25%? Yeah, absolutely I can. But what happens to these moves is not that much. Okay, you have that push up and then it pulls back into deeper. So the point is you're going to get more trades and higher value trades from kind of discount areas and premium areas. I'm talking about top 25, bottom 25, but you can absolutely sell from the middle 25%. And on ISCs and MSUs, ultimately you are able to trade, once you get into that top half. Okay, hope that answers the question.
Yeah, I think just to add on to that if it all just depends on the time frame as well. I think if the lower the time frame you go, you're going to find less trades that come back into premium or discount. But the higher time frame, there's obviously a lot more money that's fueled that move, so there needs to be a lot longer for price to come down or come up and do its thing before it can then continue in its direction. Because the higher time frames you go, you're going to end up seeing a lot smoother price. I think it's probably the best way to put it.
Yeah. Fair.
Whereas if you look at the daily compared to the 1 minute, the 1 minute just looks like an absolute shit show. But the daily, then it just looks like price comes up, price comes down, price comes up, price comes down, and it all looks very obvious, to say the least. But on a lower time frame, so there you go. There it's coming to discount, and then next bullish range, it's actually swept it, which is, we know that's absolutely fine, but all it's done is come even further into discount of the previous range. And even on the way down in the ranges from the highest point there, price comes up to maybe halfway of the first breakdown. Yeah, so there you go. But then on a 5 minute or a 1 minute, you just have to be aware that if you are going to wait for your premium and your discount zones, you might miss trades. But taking it in the bottom section, the less premium or the less discount, it's still okay. Because at the end of the day, if you're on a 5 minute chart and you're in line with the 4 hour, if you take it on of a 5 minute range of the premium or discount, it's still a relatively small amount compared to a 4 hour range which you might be trading in. So
I think when we
it's
think
still okay to take these trades.
in terms of liquidity as well, there's obviously more liquidity in this section up here than there is there, which is why this pullback didn't have enough fuel to take out liquidity lows, whereas this pullback did, and it took that external level there. So we're not, not saying that you can't trade from the middle 25%, but you treat it very similarly to range liquidity. If any of you have watched those videos lately or remember from those videos, with range liquidity, we always take trade profits a little bit earlier. Okay, if you're trading off the back of that high there, the pullback is much less likely to be big, if that makes sense. Whereas if you are trading off external liquidity, you're much more likely to have a bigger pullback. And with that notion in mind, whilst we could push down further, the likely outcome here is, because we've taken external liquidity, the likely outcome here for Euro USD is that ultimately we're going to push and take out some more liquidity up here. Despite what these candles are showing us, does this just mean that we come down, we take out some liquidity of this bottom range, and then we push back up? Well, the likelihood is that that is going to happen, because we've had this bullish price action on the daily, which has come into premium. It's then pulled back quite correctively, swept external, and then immediately started moving off. And when you start then factoring in these liquidity levels into your trading on a more, what's what I'm looking for, when you start really committing to them, there's so many trades that historically I've lost, and I've looked back and been like, oh, why did I lose that? And it's like, well, it took an external liquidity level. So the likely final result is that it's going to take this external liquidity level. Because if we're using liquidity level to liquidity level, externals are the best ones. So that fueled move is very, very likely to come into premium up there.
Yeah, like it.
Next question. Does anyone here have any? Does anyone here have any questions? You're all sitting there very, very quietly listening to me and Nat are on. But does anyone have any questions whilst we're here? You'd like me to answer? All right, on to the next then, Jakey boy.
Cool. Could you talk about why you only trade USD CHF?
Because I love them.
USD?
I love them. All right, I'm in love with them.
Okay.
Why do I always trade them?
Hold on. Yeah. And whether there are negative correlations.
Oh, we're going to talk about the DXY, won't we? Yeah. Okay.
Yeah, and then also correlations between those two and Dixie, etc.
Okay, so I really like USD CHF. I find that it compares really nicely to the DXY, okay? So if I put my DXY chart on here, okay, you can see that how closely it follows it. And, oh God, let me just zoom in, okay? You can get a really clear understanding of what the dollar is going to do with DXY ultimately. So for those of you who don't know what the DXY is, it's what's classed as a basket. It is a collection of dollar pairs all averaged out into one chart, okay? What is great for the DXY, and I need to do a video for you guys on this because I realized that we didn't actually include it in the course, but what's really good for the DXY is you can get divergence on it, where the DXY is making higher highs. I can't zoom in on it any further, sorry guys, otherwise it will lose its positioning, as you'll see like that, okay? Which makes it then confusing. Let me see if I can get you a better view of it. Okay, this, you can see how closely it's correlated.
Oh, that was it.
It was there, wasn't it? It's gone. I lost it. Right, okay.
There.
So, lower high, higher high, yeah? Okay, whereas we are leveling out, but I'd actually use this one and this one, okay? So if you use those 2 points there and those 2 points there, okay, this is what we call divergence, where we are making a lower high and a higher high, but the chart that we're trading is making a higher high and a lower high. That gives us an indication that the likely outcome is that we are going to push bearish, okay? Because we've reached a high here, we've swept liquidity on the DXY, but we've lost strength on USD CHF. So for me, I'd be looking at that thinking, do you know what? That's probably a good area for me to take a sell from. Same thing applies here. So higher high, higher low, lower high. I'm going to ignore that wick. Lower high. Oh God. Lower high, higher high. Okay, that for me is divergence. I'm going to be taking that trade more likely because we have that disparity in price, and they're really good to compare to each other. As you can see from when we're zooming in and out on this chart, okay, they're really closely correlated, and then therefore it makes it much easier for me to trade because I can see things happening. So you can see that DXY losing strength, whereas this is gaining strength. That won't last forever. Okay, that is a divergence in the marketplace, and the indication is that the DXY is losing strength, which means if USD CHF is gaining strength, that disparity indicates that we are probably going to be pushing bearish, and it's really handy to use. The reason why I use USD and let's see if I can invert it for you. It inverts both of them annoyingly. The reason why I love to use Euro USD is because it is basically the exact same. If I just get rid of my DXY, 2 seconds. Okay, so if I take this little price leg here and just that little section here, if you look at Euro USD and then you go back and look at, it's going to be really difficult to find.
Side by side.
Sync layout. That's not synced at all, is it?
Check your dollars on 3 minutes. Let's change it to daily.
Yeah, dollars on 3. Yeah, Dixie's on 3 minutes.
Yeah, but it should sync up.
Yeah, but you need to change the interval on that box. Click on that box and interval.
Oh, yeah, cheers. Okay, so if we're looking at this, okay, and this is the inverse, okay, you see that it's basically the exact same chart. And the beauty of that is that you can then trade it really nicely. So we've got our highs here, lower high. And again, when you've got divergence on these ones, obviously this would be the inverse in real life markets. When you've got the divergence on these ones, it again makes it much easier to trade as well. So these are the reasons why I trade these two pairs. They really closely correlate to the DXY. I toyed a little while ago of getting rid of the DXY because I was doing a lot of backtesting. I was finding that backtesting wasn't using the DXY because it's you can't really do it. It makes it really difficult to trade from. And I really missed it. I really missed that confluence. So it's definitely something I'm going to be doing a couple of videos on for you guys just to show you how I would use it in a bit more detail. But yeah, the DXY just gives you an added confluence ultimately, so that you know when you're taking trades, you've got another confluent factor. If you've got a setup appearing, and what's quite good about the DXY is it'll often have slightly different liquidity levels. So what you can do with that is you can, and I used to have this quite a lot, I would trade, say, a Euro USD liquidity sweep, and I take a trade off it, and then the trade would fail. When you go to the DXY, you see the DXY hasn't actually swept its liquidity yet. So let's say you've got both charts coming into a liquidity level. Let's have a look. Let's see if I can find a good example. That's not a good example. It's really difficult to pinpoint now, obviously, isn't it? Yeah. So I've got a liquidity level here, like that. And I've got liquidity level here, like that. Okay. You can see here, Euro USD has swept at 230. Okay. And what you'll have seen on there is DXY would have swept. See that candle there has moved a lot further below the liquidity level. Okay. DXY would have therefore swept earlier. See if I can get you a replay tool and show you. Firstly, if you've made it this far, thank you for watching. I've got a freebie for you. Go ahead and hit that like button below and comment with the word VID for an exclusive free video from the 2024 Strong Money Forex Mentorship course. Side note, if you want to know more about the Strong Money Forex Bootcamp, send me a message on Instagram. Why is it not working? So liquidity level. Okay, liquidity level was swept on the DXY at 2:25 p.m. Liquidity level was swept on Euro USD at 2:55 p.m. Okay, what then therefore happened is the DXY moved further down for the Euro USD to take its liquidity, and then you had the ISC, Impulse, Imbalance, nice MSU set up in there. You could have bought from there. So what used to happen is I would be trading, let's say these were the opposite way round, I'd be trading Euro USD, I would take a buy like this and get stopped out and be like, oh shit, why has that happened? Well, that's happened because this chart hasn't taken its liquidity. So that's one of the key confluences that I'll use with DXY is, you know, if these were the other way around, or even if they're not, to be fair these days, if one of them swept liquidity but the other one hasn't, then it's not a valid trade. Okay, we need both of the liquidity points to be swept. And if the DXY hasn't swept its liquidity, well, there's a reason for that. There's a reason for the dollar hasn't yet taken the liquidity it needs for it to move higher. Okay, and what you can see how price, you know, so that's where the DXY swept its liquidity here. Price came down, Euro USD swept its liquidity, and then they both moved off. So that's why I quite like using both of them together, making sure that if I've got DXY sweeping liquidity, giving me Impulse, Imbalance, MSU, and then I've got Euro USD doing the same, then I know I've got, you know, extra confluences to my trades ultimately.
Yeah, decent.
Nice. Right, that was going to be a short and sweet one today, guys. I'm really sorry, I've got to go. I'm doing a market forecast right now that you're welcome to join. I'll put the Discord link in the chat. Okay, I'm going to jump over to another Discord and forecast the market. Obviously, you know, we don't have to wait for these webinars. If you guys ever have any questions or queries for me, you're always welcome to jump on. If you need anything explained in more detail, we can do, you know, video recordings and that sort of thing. You've all got your one-to-ones available as well. I know a couple of you have started getting those in, so if any of you want your one-to-ones coming up in the next couple of weeks, then just let me know. We'll book a time and we'll get those sorted as well. All right. If I don't see you, have a great Sunday evening. If I do see you, I'll see you on the next Discord.
Awesome, boys.
Cool. Cheers.